Topic introduces curve-based and empirical fixed income risk measures used to evaluate interest rate sensitivity more accurately in complex bond markets. Traditional duration and convexity measures assume parallel shifts in yield curves and fixed cash flows, which may not adequately capture the behavior of bonds with embedded options or changing market conditions. Curve-based measures improve risk analysis by considering shifts in benchmark yield curves and changes in expected cash flows. Empirical measures, meanwhile, rely on observed market data rather than purely theoretical assumptions. These advanced risk measures are essential for modern fixed income portfolio management because they provide more realistic assessments of bond price sensitivity and interest rate exposure. Effective duration is a key curve-based risk measure introduced in the topic. Unlike modified duration, which assumes fixed cash flows, effective duration accounts for the possibility that bond cash flows may change when interest rates fluctuate. This feature makes effective duration especially appropriate for bonds with embedded options such as callable, putable, or mortgage-backed securities. Effective duration estimates price sensitivity by measuring how a bond's market price changes when benchmark yields shift slightly upward or downward. Because embedded options alter expected future cash flows, effective duration provides a more realistic assessment of interest rate risk for option-affected fixed income securities than traditional yield-based duration measures. Effective convexity extends the concept of effective duration by capturing the curvature of the price-yield relationship for bonds with variable cash flows. Like traditional convexity, effective convexity improves estimates of bond price changes resulting from yield movements. However, it also incorporates the effects of embedded options and changing cash flow expectations. For example, callable bonds may exhibit negative convexity because declining interest rates increase the likelihood of early redemption, limiting price appreciation. Effective convexity therefore provides more accurate risk analysis for securities whose future cash flows depend on interest rate movements. Investors use effective duration and effective convexity together to evaluate the complex behavior of option-sensitive fixed income instruments. The topic also explains how effective duration and convexity can be used to estimate percentage price changes resulting from shifts in benchmark yields. Effective duration measures the approximate linear price effect of a yield change, while effective convexity refines that estimate by accounting for nonlinear curvature. Combining these measures improves the accuracy of projected price changes, particularly for larger movements in interest rates. Portfolio managers rely on these calculations to assess potential gains or losses under various interest rate scenarios and to construct portfolios consistent with targeted risk exposures. These tools are especially important in environments where monetary policy shifts or market volatility create significant uncertainty regarding future yield movements. Key rate duration is another important curve-based measure discussed in the program. Unlike traditional duration measures that assume parallel yield curve shifts, key rate duration evaluates a bond's sensitivity to changes in yields at specific maturities along the yield curve. For example, a bond may respond differently to changes in 2-year rates than to changes in 10-year rates. By analyzing multiple key maturities separately, investors can identify how different parts of the yield curve affect bond prices. Key rate duration is especially valuable for managing portfolios exposed to non-parallel yield curve movements such as steepening, flattening, or twisting yield curve scenarios. The distinction between analytical duration and empirical duration is also emphasized in topic. Analytical duration is calculated using valuation models and assumptions about cash flows and yield changes. It relies on mathematical relationships derived from bond pricing formulas. Empirical duration, by contrast, is estimated using historical market data and observed price movements relative to benchmark yield changes. Empirical duration reflects actual market behavior and may capture factors such as liquidity conditions, investor sentiment, or market inefficiencies that analytical models overlook. Analysts often compare analytical and empirical measures to evaluate model accuracy and better understand real-world bond price behavior under changing market conditions. Curve-based and empirical risk measures are particularly important for managing portfolios containing mortgage-backed securities, callable bonds, and structured products. These instruments exhibit complex cash flow behavior because borrowers or issuers may alter payment patterns when interest rates change. Traditional duration measures may underestimate or overestimate actual risk exposure for such securities. Effective duration, effective convexity, and key rate duration provide more reliable estimates by incorporating changing cash flows and non-parallel yield curve movements. Institutional investors, including banks, pension funds, and insurance companies, use these tools extensively to evaluate interest rate exposure, design hedging strategies, and manage fixed income portfolios under dynamic market conditions. Topic ultimately demonstrates that advanced risk measures are essential for accurately evaluating fixed income securities and managing portfolio risk in modern financial markets. Effective duration and convexity improve sensitivity analysis for bonds with embedded options, while key rate duration captures the effects of non-parallel yield curve shifts. Empirical measures provide additional insights based on observed market behavior rather than theoretical assumptions alone. Together, these tools enable analysts and portfolio managers to assess interest rate exposure more comprehensively, improve portfolio construction, and respond more effectively to evolving market conditions. Mastery of these concepts is therefore critical for sophisticated fixed income analysis and professional investment management.